Anybody who wants to go and serve themselves, they can serve, but excellent. Thank you very much and welcome this morning to our investor briefing session for the third quarter. We are grateful that managed to join us this morning. And without much ado, let's look at the environment within which the business has operated for the last 9 months. Looking at the macroeconomic and operating environment, we see how the East African economies, Kenya, Tanzania, Uganda, Rwanda, and DRC, all on a very strong GDP growth trajectory. And we see almost the whole region around almost nearly 6.6% growth rate for the entire region. And given where the rest of Africa is, we would say then as a group, we are operating in a fairly robust environment. So that, and we see very strong monetary policies that are supportive of economic growth. We are seeing central bank rates reducing to a stable position across the whole of East African region. We see exchange rates just a marginal depreciations, and we see inflation within targeted range and basically low inflation environment. So the three microeconomic prices are all with tending towards the right direction. And as a result, then we can conclusively say that the region is depicting a strong economic growth outlook in the entire region. While DRC may look slightly below the others, it's the economy that is experiencing the fastest recovery, just remembering that we are coming from 1.8, and that already we're headed towards 4 as we speak. So that we hope that recovery will be completed. The second aspect is relativity. And when you look in terms of the African continent, then we can confidently declare the East and Central Africa as the fastest growing region in Africa, and maybe one of the fastest growing regions in the world, and with outlook of sustained above 6% growth rate, almost comparing with East Asia. The World Bank increased confidence in attractiveness, particularly of Kenya, the ease of doing business ranking, where Kenya, just 1 year has improved from position 80 to position 61. This is a very significant jump. Those who has been following this indicator know we have moved from position 132. From position 132 in just 3 years. That shows really the impact that the policies, reforms are having. And of course, the Kenyan currency, despite what the latest indication by IMF are, we see currency holding against the peers in terms of exchange rates. And we see renewed vigor to economic crimes. And hopefully, the expectations are heightened on compliance for financial institutions. And we have seen what the financial institutions have gone through in proposed penalties. So essentially, we are seeing an environment that seems to be improving from a policy perspective, and we see some sustained political will to ensure the environment get it right. The establishment of the Kenya Mortgage Refinance Company brings in a dimension of long-term funding availability within the market. And whether it will be pension funds, whether it will be unclaimed assets that will be put here, or is a special tax, what we are really seeing is then the maturity period, a prolonged period for investment that sustains long-term investment. And the focus particularly, the economy says, yes, we have so many sectors in the economy, but if we focus on these the big four agenda, we can have this significant impact. So hopefully those sectoral focus will really give, so very bullish view about the economy. But there are concerns, of course. Operating environment may just have one black swan that really, and the interest capping continues to frustrate the private sector. And we still see that despite all these efforts, private sector growth rate, credit growth rate is still at 4%, which can sustain a 6% GDP growth rate. There is no way you can grow economy at 6% and you are funding it at a growth rate of 4%. That mismatch that then suggests that that is a huge challenge that we still have to deal with. And for the investing community, and particularly for the banks, the margins in the banking industry are shrinking very, very fast. The central bank this year has lowered the central bank rate from 10% to 9%, meaning the interest rate have fallen from 14% to 13%. And all lenders regulated under the Banking Act have lost, or they have been shaven 100 basis points in interest rates. And when it may look small, but 1% out of 13% is nearly 8–9% of the total interest that banks were earning. So it's very significant. But the compression is even bigger when you look at interest rate on investments in treasury bills. And we have seen that the short-end, Motuko, we have lost 200 basis points. We have lost 200 basis points. So you lose 100 basis points on your loan book, and you lose 200 basis points on your investment stock in government securities. So that essentially has been fairly significant. And the cost of interest cost has just declined by not even 100 basis points, by 70 basis points. So that can't compensate the decline. That we'll see it playing in the banking industry and any financial institution that is. And then to complete the story of the yields, then you look at those who are lending in foreign currency, US dollar. Over the last 1 year or so, the RIBOR has moved from 45 cents. We are now at 2.8% or thereabout, suggesting again the interest margins on dollar-denominated loans were fixed, have been compressed by nearly 250 basis points. It is not really, in terms of application of the interest rate as a price, it has been quite, but I think the biggest challenge that still we are coming to terms with is Parliament's surprise retention of the interest capping law. And that, as we said, continues to hinder credit flow or liquidity flow to the real economy. So basically, that's really what we are continuing to see a bigger position. So in a nutshell, that is how we see the macroeconomic environment. There are many slides on the economy, but we have put them at the upper deck so that you could really look at, and we'll give you this presentation. Now, coming to the organization, those who know, Equity has performed well consistently over this period because of two things: a governance structure and a very strong leadership team. And if I just take 2 minutes to focus on that, we are at a level, because we are coming from a defensive position. The microeconomic environment was very challenging. We took a very defensive position of a very agile balance sheet and a very strong liquidity position. As this situation is, and we see the economies starting to be very bullish, we have really strengthened our leadership team. And that's it about 6 banking subsidiaries. And today we are very privileged to have most of the MDs of those subsidiaries. And I just want to invite the managing directors of our subsidiaries who are with us to quickly come forward so that people can see the team. Please. Very good. The last time we were with Polycarp here, he was a chief commercial, I don't know what, but today I present to you the managing director of Equity Bank Kenya. And for us in the bank, we have come to really respect people who operate in the fast mover goods industry, or FMGs. I think they know. And we have started seeing, like Equity, who sell loans, savings, deposits, cards, like we sell sugar, and what else? And Coca-Cola, as he says, and many other things. So we are seeing a change in the way we manage the bank. And we're very excited about Polycarp taking our largest subsidiary that controls about 75% of our balance sheet and about 82% of our profitability. Next to Polycarp, I think, Celestine, why don't you come closer to... Let's see the challenger of Kenya. Amazingly, in just under 3 years, we're now seeing, under the leadership of Celestine, DLC has become the second largest subsidiary for Equity Bank. And it's not just that it's the second largest, it's growing about 12 times faster than Kenya. And the question is, how long will it take to catch up with Kenya? The great mathematicians and statisticians in the room can take that geometrical trajectory, and it looks like within time we'll see a very substantial. What are we talking about? We are talking about a subsidiary that has grown its balance sheet year on year at 133%. When Kenya has grown its balance sheet, I think with 6%. So Elizabeth, how many 6 are there in 133? 20-something. And we are very, very encouraged by DLC. And we couldn't have been more excited seeing DLC developing a formula of being able to conduct its elections. And of course, Uganda comes in as the third largest subsidiary, and we have some there, again, a subsidiary that's growing at around 45%, rather maybe 8 times faster than Kenya. And of course, the next MD, I'm sure you can guess from which subsidiary. South Sudan, Addis, again, as we promised, he has managed to sustain our license, and it's not only the operations are covering, they are profitable, and he's not damaging the group performance despite the challenge. Unfortunately, we're missing the MD of Tanzania and the MD of Rwanda, both also doing fairly well. So I present to you one common thing, as you can see there, young and energetic. So they really are up to the task that we can. But what you can't see may be, but you can hear and you can understand is the experience that they bring on the table. So in just 1 minute, each of you, why don't you let our investors know a little bit of what they can't see.
Thank you very much, James. My name is Polly Kapigathe, and I come from a fast-moving consumer goods background. Started my career out in Coca-Cola in senior commercial roles. I've worked for East African Breweries Diageo. I've worked for Africa Online. I've also been CEO of Hako Industries and CEO Group, East African CEO for Tiger Brands International, which then acquired Hako Industries, and then moved over to become CEO of Vivo Energy, the company behind Shell Brands in Kenya. And through that journey, I've also been in the private sector advocacy as chairman of the Association of Manufacturers, as chairman of the Petroleum Institute of East Africa, and very, very delighted to have the challenge to lead Kenya, and excited that we can take an offensive stance and catch up with my brother in DRC and overtake him. Thank you very much.
Thank you very much. Yeah, thank you. I'm Celestin Mukeba. I'm an economist. I was working in the banking industry for 12 years from now. I was appointed as deputy CEO in 2008. It was the same day Obama was elected. I remember I was taking my position as deputy managing director in the financial crisis. We managed to lead the bank at that time up to 2014 when I was appointed as an MD. I mean, I led the challenge of bringing the bank to the next level, especially when equity entered the market. We had only 13 branches. Now we have 41 branches within 2 years, so it was an impressive growth. And we managed to launch equity model with being the first bank of launching agency banking. Currently, we have close to 2,000 agents across the country, and even the transaction in agency banking overtook the brick and mortar branches. So we are very excited to take that challenge, and we think that in the coming years we will be challenging seriously Kenya.
A little bit about what has he achieved. We bought ProCredit approximately 3 years ago when the economy was growing at nearly 13% GDP. Within those 3 years, we saw the economy come down all the way to 1.8, now recovering 3.3. But what happened to equity? The balance sheet has more than tripled in that short period. And now we are asking, with the commodity prices where they are, and DRC projected next year to touch between 6 and 8% GDP growth rate, can we repeat what we saw in Kenya, 150% compounded? We can go 5% compared to Kenya, 85%. So it's huge headroom for DRC to really grow. What else?
Yeah,
a population
of 85 million.
85 million against Kenya's 45 or whatever it is. That is what, and mineral wealth, approximately 36% of all natural mineral wealth of the world is in DRC. So that's what we are seeing, the potential of DRC. Thank you.
Thank you. Good morning. My name is Samuel Kirubi. I'm the Managing Director for Equity Bank Uganda. Being my career life in Equity Bank for the last 20 years, I joined Uganda in 2016, but before Equity Uganda was in Rwanda since 2011, and then before with Equity South Sudan, and before worked with Equity Kenya as an officer. Uganda, exciting. We are turning things loud, just like Congo implemented huge payment system, and the growth of the country, the revival of agriculture in Uganda, and the trade between the East African countries is leveraging the growth. So we are currently seeing 40 to 45% year-on-year growth, both on balance sheet, both on profitability, and we hope maybe for the next 5 years we can sustain that. Thank you.
So it is them speaking, not me. So we can hold them to their projections, but they have demonstrated. Let me say, long we struggled with Uganda for approximately 7-8 years. And in just under 2 years, Sam turned Uganda loud. I think he went to Uganda when it was making a profit equivalent to 200 million Kenya shillings. Last year, he gave us 1.2 billion shillings. And we are optimistic that this year he'll give us nothing short of 1.5 billion shillings. So about 5-6-fold growth within a period of 2 years. He entered Uganda when it was position 14 in the banking industry. Our Uganda subsidiary is now position 6. So it's quite a dramatic move. DLC, we bought DLC when it was position 7, and now position
4. We're reaching 3.
4, and he's optimistic we shall close this year with position 3 in the whole market. So we're almost going where we wanted to play, only play in markets where we are number 1 to number 5, not beyond there.
Thank you very much. Very good morning. My name is Addis Ababoto, a man with a funny name. I'm from South Sudan. I started actually working for university as a teaching assistant back in 1996, then joined Central Bank of Sudan as an inspector in 1997, then left to Holland and I started working with an auditing firm called Dubois and Anco. I came back in 2010, thought of being part of nation-building projects of South Sudan. So started working as a consultant for anti-corruption commissions of South Sudan, and later joined the Central Bank of South Sudan as head of planning, regulations, and licensing. I find myself joining Equity 2015 simply because of a mission and a vision. And having worked for Central Bank and mainly in the supervision department, I thought it will be easy work. But again, working in environments that is so challenging like South Sudan, and you know that we've been hit by war that has erupted in 2013, 2016. So we got ourselves in a very tough situation. But again, because of the business mode and the model that we have adopted, we have managed to sustain the growth that were there. Although 2016 we have booked a loss, but 2017 we managed to book a profit, and we are hopeful that 2018 and maybe going forward things will change. I know this is a very challenging environment, but again we are up to challenge.
Thank you very much, Addis. A very confident our team. Thank you very much, colleagues. So that I took advantage of their presence here. The team continues to grow, and maybe I will just introduce. As learning the lessons of what banks has gone through, we have enhanced particularly our IT capabilities, and we have been joined now from an IT department just to strengthen our IT department by Innocent Hatege Kimani. Maybe you could, he will be in charge of databases and networks. And then we have filled the position of the Group Director of Risk and Compliance, Javan Sangano. Javan maybe, so again, why have we filled these positions? Because these are the most challenging department or sectors now in the banking industry. It's all about risk management, and it's about defending yourself and remaining secure in a cyber crime environment. So strengthen databases, ensure the database is secure, and ensure the wide area network is secure. And of course, Dennis and Kamal, these are data scientists. Where is Kamal? He has not joined us. Oh, very good. Data scientists. We have realized, as I said in the past, data is the new oil. These two gentlemen who holds PhD in data science has helped us to reorganize our data, interpret trends, and with data analytics capability now headed by Batesh, I think we have really got it right, and we can tell where the bank is and the trends of the industry. So again, strengthening leadership, leadership, leadership. Thank you very much, the scientist. And lastly is a position that had fallen vacant. We have been able to fill in the position of the Group Finance Director, and I just want to invite David to come and introduce himself. Analysts are always keen and interested in finance director. Please.
Sorry. Thank you, James. Good morning, everybody. Okay, my name is David Gata. I am very excited to be joining Equity. A little bit about myself. As you can tell, Gata is a Kenyan name, so I'm Kenyan born and bred, but started my career here with the public accounting firm of KPMG. In 2004, I was part of the brain drain. I went to the US. I've been in the US the last 14 years. I worked with KPMG over there. Then I joined one of the anchor brands in the US, American Express, where within American Express, I ended up establishing a data analytics practice for the internal audit group of Global Internal Audit Group of American Express. And then 2 months ago, I was very excited to be joining Equity. I'm extremely excited about the talent that I get to work alongside. And there's no day which the last 2 months I haven't gone to bed excited about the challenge in front of us and the opportunity that that challenge represents.
So, Batesh,
thank you.
We'll come forward together. So we are very lucky now. We have data scientists who have been able to reorganize our data, and at operational level, we have an analyst, and now at the finance level, we have a data analyst. So you can imagine this combination, what it will do. American Express is the Amex cards. And so what are we using is that analytic capability of the most maybe highest ranked card or credit card ranked on us, and say, what can we do that on mobile banking? Not now on card, but on mobile banking. And we are using those insights that he has brought, the analytics and selling skills, and the collaboration between the two has helped. But just briefly about data and analytics in the bank.
Sure. I think when you look at it, Equity Group sits on not only transactional data, but also movement, payment, and lifestyle data for nearly 13 million customers. And to be honest, until now we haven't even started scratching the surface on how we can use that to make decisions, whether it's risk-based decisions or cross-selling decisions. So I think if you think about data as a new oil, it's not yet even come out of the ground, and the opportunity is huge on what we can do over the very short period of time on that.
So that's the data driving our mobile banking. Thank you very much. Now let's go to numbers. But it was important to know the people bringing out the numbers. The business model has not changed. Brent and Mary are really focused on really execution of the post-interest rate capping, which fortified liquidity, made budget, balance sheet agile, and focused on non-funded income and regional expansion, and of course, efficiencies and cost optimization, in addition to innovation and an asset quality focus. How are we doing? Non-funded, we seem to have made continuous effort. As we can see, yes, we still a far cry from the interest we had made before the interest capping of 34 billion. We're still up slightly $1 billion higher than last year, and we're very excited that, yeah, we have found a formula of growing our interest income gradually. And we see total income, we're almost where we were in 2016. That 40 billion, we are now 38.5 billion. And non-funded, as we can see, has increased from 16.6 billion to 19.8 billion over that period. And when you combine interest income and non-funded, we are very, very excited that now total income for the 9 months at 49.3 billion is higher than the income of 48.9 billion that we had achieved September 2016 before interest capping. That to me is the greatest achievement in a period of 2 years. Why is it such a great achievement? Because if you look, we lost in 2017, we lost nearly 40% of our interest income. So essentially, having recovered that through other incomes, it's not about cost cutting. Notice the strategy here is not about cost cutting. It's cost cutting, you can do it for a year or two at most. It's how do you get back to interest income growth. The top line must grow, and we are very excited that our interest income is fees and commissions, the non-funded income. Is it sustainable? When you look at where it has come from, the main one, merchant commission, trade finance, board trading, diaspora remittances, and we can see these are all sustainable streams of income. And essentially, then we can see that the past is behind us. The challenges of interest capping, the shock of the interest capping is behind us, and now we can look forward to sustained growth. And we'll use this momentum of non-funded income to now propel the growth of income. And of course, one area that required a lot of efficiency is treasury. And we said treasury allowed us to play a very defensive position, very agile balance sheet, near cash of nearly 160 billion, and very liquid to absorb any shock. But now we are converting this from being defensive to really opportunity as the market improves. As GDP takes off, we have 160 billion shillings that we can release to the market. If interest caps are removed, you can see how quickly this can play. I'm very confident nobody in the market is this well positioned, that you have liquidity that you can unleash to any opportunity that appears in the marketplace. But we're also very excited about the yields, that despite the interest income on bonds coming down, the yields have remained almost the same, 11.4 and 11.3. And Mutuku, we are very, very grateful for the way you have managed to sweat the balance sheet, really, and sustain. If you look at the yields on treasury bonds are higher than the yields on the loan book. And that's what one can't. And we're very, very grateful. And because of the declining interest, while we might have lost 0.1% yield on treasury bills from 11.4, look at how it is compensated by unrealized capital gains, because we took a position and then the market dropped by 200 basis points. So what does it mean? It's about unrealized gain of 1.2 billion shillings that at short notice, because the bonds are all tradable, can be converted into profit. The third area of focus was the regional, and we were lucky to have the MDs. And we can see what has happened, the rapid growth of the subsidiaries. In 2017, they were only contributing 23% of total deposits. They are now contributing 26%, growing faster than Kenya. In loans, they were contributing 22%. They are now contributing 25%. Asset growth from 23 to 26%. But most important is their profit contribution has jumped from 14% of the total group profit to 18%, and after tax from 14 to 19, suggesting they're even more efficient in tax management. So we're very, very excited about the third strategy and to us, the biggest advantage is what was alluded here earlier, that the biggest opportunity now is trade finance. Africa has signed the Continental Free Trade Area, and we are covering the East and Central Africa. And we can be not just a catalyst, but also lead, facilitate trade in the region. We're now seeing trade in the region is approximately 32%. And we're saying that provides us a huge opportunity as a bank. Area number 4 was balance sheet agility. We have talked a lot about it. Well funded by 3 main sources: deposit, shareholders, and borrowed funds. What did we do? If you look, we increased our long-term funds to ensure there is no mismatch, to create stability, there is no maturity on the long-term funds. 10% of our total funding is long-term, and 16% is permanent, the shareholders' funds. And depositors are only contributing 72% of the total funding. But it's the application of that funding that makes the balance sheet very agile. Loans only contribute 51% of our assets. The bulk of assets, as we said, 14 plus 28, that is 42% of all our assets are cash and near cash. And that's what we are saying. We can unleash that cash to the marketplace very, very fast, given that we have now significantly digitized the bank. And that is what we are calling agile and very liquid balance sheet. And the same happens at the Kenya level. If you look at the Kenya level, it's the same. And if you look at quality, it's not just agility, it's the liquidity is very, very strong, but the banking, if you look at that liquidity compared to the banking industry. Equity is almost at 60% liquid, and the banking industry is at 48. So again, you can see the depth of capability, latent power, if you may wish to call it, and that is likely to position. And of course, the most interesting is what is equity doing to lead a position itself to the future. And we have seen now it's clear to everybody why we went to the telecom industry through the MVNO, Equitel. Amazing story. Internet has only managed for the first 9 months to do 1 million transactions. Branches have only done 13 million transactions. And suddenly you see agents who are interlinked through Equitel have done 53 million transactions, more than 4 times the number of transactions done by the branches. But it's Equitel, the mobile app and the SIM-based Equitel app doing 353 million transactions, about nearly 300 times more number of transactions. What has the mobile capability offered? It has offered people convenience. They have their bank wherever they are. The second thing, it has removed the geography, that is location, from people's lives. They don't have to go to a specific place to do banking. They do banking wherever they are. And the third and most significant, it has removed time dimension in people's life. You do banking whatever time you want, wherever you are, whatever time. And that has been the most significant. And that is the future for us. That is the future. What is most important about this slide? This slide has no brick and mortar. The brick and mortar were in ATMs and branches. That brought in our books fixed cost. Agents is variable cost. We only pay agents if they transact. Mobile, people serve themselves. There is nobody to be paid. There is no cost on these transactions other than the data center that we built 2-3 years ago. And that explains why the cost structure of equity for the last 4 years has been coming down. I've been very privileged to see a bank where cost goes down for 4 consecutive years. And I can promise you, even next year, cost will be. What are we seeing? The jaw is widening. Why? Because the bulk of transactions using the mobile, there is no cost. It's self-service. And I know people will ask me, James, you have captured 20% of the mobile space. Why are we not seeing the revenue on that? It's simply because we said, let's capture the market, let's give the incentives, and then later, we can monetize. So what can you see? You may not see revenue, but you can see the cost reduction. If we have, I think, Gerard, we have about how many cashiers? 400 cashiers are running 13 million transactions. Just tell me how many cashiers I would have needed to serve 353 million. That is the cost reduction that the bank is enjoying. The mobile, initially, we entered as a service and a cost reduction driver. Remove the fixed cost. Remove all these. And then later on, we can really monetize. And just a comparative picture will tell you, just not the number of transactions alone, but the volume they are handling. And as we can see, the biggest driver of transactions and volume was Equitel. And then it's closely followed by agency. But suddenly, in a year, those who can remember, we launched EasyApp last year. Now it is challenging Equitel. What does it tell? The story is Kenyans have adopted smartphones. Equitel is feature phones. And EasyApp is the smartphones. The tide has taken off. And what is the advantage? Equitel has a cost structure because we own the MVNO. The app has no cost structure because the customer owns the phone and they choose whichever mobile. So there is no infrastructure cost for us. So, and that's why we're saying the more we go to smartphones, the more the cost structure of the bank will go down significantly. Let me introduce one thing that I wish you look at, what we are calling EasyBiz. It looks very small in number of transactions, 1.2 million transactions, but look at the value those transactions are carrying. 1.2 million transactions, but 187 billion shillings in value. Now, this is the app or the Equitel of the business of large enterprises and SMEs. This is a cash and liquidity management solutions. Again, we are seeing a future where SMEs will no longer need to come to the bank also. They will do business on corporate internet platforms. And hopefully by next year, we are very optimistic that that will be the largest driver of volume of transactions. And I can bet it will have overtaken Equitel, it will have overtaken the EasyApp, and it will have overtaken agency banking. And lastly, if you look at the branches, the transactions have continued to decrease from 14.4 million to 13.5 million, giving us an opportunity now to use branches as centers of relationship management. We can pay attention to customers. It's no longer a transactional, branches are not a transactional site. They are relationship, they are advisory centers, they are wealth management, and branches have become significant actors for SMEs and high net worth individuals. There is no more queues and there is no more congestion in the branches. And essentially you can see the volume. Despite the transactions coming down by 1 million, the value has remained the same. The big one was the fintech. Remember we relaunched FinServe now as a fintech, not as an infrastructure. And we can see what the first product was merchant banking. And this is where we have received the greatest growth, merchant banking. I'm told reliably, Rebecca, what is our market share of merchant banking in the marketplace? 52%. For every transactions that are processed by merchants, one comes to Equity. The other one can go to any of the 43 banks. That's how significant innovation has positioned the bank. And now, what have we discovered? We have now the network effect. Why? Because our merchant POS can process. There is no international money merchant processor wants to be left out. So we have now the magic POS from American Express, JCB of Japan, China Union Pay, Diners Club, Visa, MasterCard, they have all been put in one POS, giving merchants the convenience that we could require. And if you look at also outlets, 18%, 34% growth rate last year, again, people are accepting digital electronic money as opposed to cash. That's what it means. Increasingly, merchants want to move away from cash. The fintech second largest innovation is diaspora banking. And again, we can see what has happened. Last year, growth was 54%, from 9.6 billion shillings of remittances to 15 billion. But see where we are, 56 billion. And Patrice, where are you? Patrice guarantees me that this year he will process more than 100 billion shillings of remittances. Patrice, are those your words? Those are his words. What does this mean? Why have we gone heavy on diaspora banking? It's not about commission. All these 100 billion shillings comes in foreign currency. So that foreign currency is given to Treasury to trade on. So we no longer have a problem of sourcing currency. None of our customers can miss now currency, because on daily basis, I think like I saw yesterday, we received $3.76 million in a single day. And he tells me before the end of the year, he'll be receiving at least 5 million US dollars. So that becomes available for our importers. They don't have to struggle for currency. And essentially, that's a big area. That is the power of fintech. The future is being invented by equity, and equity is creating volume barriers to anybody else entering that space. The future looks better than the present and much better than the past to the analysts. And we can see what digitization has done, again, the fintech. We see mobile and app 2018 are processing 79% of all our transactions. And you can see the branches, they're only processing 3%. The fixed cost self-service platform. Just imagine what is happening. So when you see cost reduction, that is the understanding that people are serving themselves. And that's why we said, let's monetize it by cost reduction other than revenue. You can either, your total income or your profit is a function of revenue and cost. So we chose to go the cost reduction route. And even if you look at the value of transaction, it's not just number of transactions, but increasingly we are seeing the value of the mobile increasing. And that's the role of EasyBiz. EasyBiz will remove the high value transactions from the branches, because the corporates, the large enterprises and SMEs can process their transaction, not from their mobile, but from their internet, corporate internet. And that will complete the digitization. So we did the individual, we did the micro, we did the small. We are now busy digitizing the large enterprises and corporates and all transactions. And Batesh tells me in a few days, you should be able to buy foreign currency online. You don't need to come to the bank to buy dollars. You just open a dollar account, you buy, you put in your dollar, and then you start transacting online. So all those, and Mutuku, is that the correct position? Are we talking of months or days?
By end of this month.
By end of this month. So you can buy dollars on a Sunday, and you can buy dollars when you are at the airport. And you can buy dollars when you are in US or Dubai and still pay somebody in Dubai. That's how easy it will be. And at the same time, you can buy insurance online. And if you have excess money, you can go to Nairobi Stock Exchange on your own and buy stocks. That's what digitization means, giving the power and the liberty and the freedom to the customer to do what they want to do. Digitization, I think the most exciting is the latest product that was launched by FinServe, what we called the social and mobile money. app. If you don't have M-Key, you are missing out, because you are going through a very long process of connecting WhatsApp, Facebook. With M-Key, you create a keyboard that you don't have to move out of an application to go to another one. You just touch a button and it pops in. So you can be talking on chat on one and you are doing your transaction on the other. Try and download. As you can see, in just launched in October, and 100,000 people have already downloaded the app, and we have given you a lot of that. If you look at this presentation, it's not about the past, it's about the future. And you can see the trend. Where is the bank going? Customers serving themselves. And we have seen, as we were told by Batesh, we are now 13 million customers. Look at the rate at which, over the last 20% growth rate in customer numbers. It's the attractiveness of convenience. And again, agency model, look at what is happening between deposits and withdrawals. The gray bars represents withdrawals, and the orange deposits. Kenyans have moved away from cash. They're just using agents as bridges of digitizing their cash and then transacting digital. They are no longer transacting cash. Very, very few. This is the phenomenon that Equity wishes to capture. That's really what we want to capture. The digital world. Create a digital bank. Lifestyle will be done digitally. So it's lifestyle that we want to support with completing payments and transactions real-time online. And we have also seen the EasyPay. It's taken off again, reviving. That is digitizing retail commerce. And that's why we said, let's not initially seek to make money from this. Let's give incentives to people to adopt. And you can do it, make it free, everybody adopts, or spend the same amount of money that you charge advertising. And you can tell me which is more persuasive, cost-free transaction or hearing adverts. That's the rationale that we have used. And, and of course, efficiencies and cost optimization. And we can see from last year, 2016, despite losing 42% of our interest income on loans, look at the cost expense trend. And look, we came from 12.7 billion shillings. We are down to 11.6 billion. And look at cost income ratio from 49 down to 48 after losing 42% of your interest income on loans. So we are very optimistic. Group cost income ratio moving from 56 to 55, and given the size of the bank. And you can see in terms of interest yields coming down, one would have expected our yields to come from 8 to 7. But see what, because we lost 100 basis points, but we are still at 8. We just lost 0. Instead of losing 100 basis points, we only lost 10 basis points. Very, very innovative ways of managing the balance sheet, making it very efficient and sweating it. And look at the cost of funds, the strength, the bedrock of Equity's strength. And asset quality, again, the industry is at 12.7 NPLs. We are at 8.7. We are not proud about it. We are used to being below 5, and we are working very, very hard to regain the lost ground. But why have we lost the ground? We all know the problem we have of non-payment of creditors. Most of the payments, and essentially that is why it's huge. And you can see, despite the increase in NPLs, the coverage has remained the same, suggesting we continue to improve. And of course, equity is a socio-economic brand. We can't finish the story of equity without looking at its social impact in society through its social investment programs through the Equity Group Foundation. And that is how the money is spent among the 8 thematic areas. They reach to the orphans and most vulnerable, and developing leadership continues to be the biggest driver. And we can see the quantum in terms of number of outreach and dollar value of what has been spent on each of thematic areas. This gives Equity Group the soul and humanizes equity and enhances the public license of operation for Equity Bank. And that is why the brand is as strong as it has been. All that data is for us and regulators. But let's see what others think when they look about equity. Moody's, we still have a positive outlook, stable outlook, and our rating is the same as the sovereign rating, the same as GCR, and we're also very excited that 2018, in the ranking of banks in the world, we even improved. Despite the Kenyan situation of interest capping, and we all know the slowdown of the economy, among the top 1,000 banks, we moved from position 806. If you remember the last time we were here, we are now 799. So we were very excited to edge 7 global banks and push them to behind us. We are really working like the Kenyan long-distance runners. It's just a question of time. Before the race is complete, we will be in a better position. But return on asset, despite interest, full year of interest capping worldwide, we still were ranked number 11. Solidness, soundness, stability of the bank, ranked 35 best bank on earth, and return on capital, we improved from position 45 to 44. And the bank, it's consistent. Sometimes it's not how fast you move. It's whether you are consistently moving forward. And for equity, it's a journey of consistent improvement, year in, year out. And that's why we say we are sure, we are certain the future will be better. Why? Because every day we make a positive step to a better position. Euromoney, Kenya's best bank. Consistency, it doesn't matter who it. Superblads, Kenya's best banking superbrand. The Business Awards, East African overall best regional company. And Banker, we have all seen best in Kenya, best in East Africa, best in Africa, and Think Business, almost every award that was awarded, position 1 came to Equity Bank. And you can see the pride of our staff in the next slide, as this to us is really, this is equity. That's what it really means. And the market, we are grateful, has taken note of our positioning, and we are still 30 billion shillings bigger by market capitalization than any other bank in the Nairobi Stock Exchange. And when you look at all the companies operating in the Nairobi Stock Exchange, we are now ranked the 2nd largest company in terms of market cap. Balance sheet has grown by 8%, driven by 9% growth in deposits. The health of a bank is determined by two things: the sentiment of the customer and the quality of their own book. As we can see, the sentiments of the customers are very bullish. Their deposits have even grown faster than the total balance sheet. They are growing at 9%. And what have we done? We have turned that money back to them in terms of loans, which have also gone up by 9%. Whatever they give, we try to give back. When they are not able to take, because the private sector seems not to be taking, then we have put that in what we call liquid, agile balance sheet. Government stocks, short-term, and tradable. And basically, we see from that balance sheet, how have we managed to sweat it? And we see, like we said, interest income, after declining by 42% last year, this year interest income has grown by 9%, interest expense by 13%, net interest income. Last year, negative, as we remember, but now a growth of 7% from negative. And of course, non-funded income, a slight decline, and total income by 1%. And cost, as we said, continuous improvement on quality of loan book. As we saw, yes, provisions are lower, but coverage has remained the same. Why? It means the loan is adequate. And equity returns an 8% growth rate in both profit before tax and profit after tax. Profit before tax increases from 20.7 billion shillings to 22.4 billion shillings, and after-tax profit increases from 14.6 billion shillings to 15.8 billion shillings. We are seeing it's a single-digit growth rate, but it has been achieved, as we said, from the earlier slides, in a very turbulent microeconomic environment in terms of interest rates. 200 basis points reduction in yields on government stock, 100% shave on yields on loans during the year. That's really what has been the biggest contributor and challenges during that period, and deteriorating NPLs for the banking industry that have now moved all the way to 12.7%. And for investors, we know returns are very, very significant. So your shares at the group level, and we can see return on equity has improved from 12.7 to 23%, and return on asset has held at 3.9%. And Kenya, we can see the impact of the shedding off of 100 basis points. Come to the ratios, because ratios tell us more about tomorrow. A very healthy bank in terms of ratios. Our core capital to risk weighted at 18%, and we're very, very optimistic. That is far above, and we see liquidity of 55%. And of course, to the shareholders, return on asset and return of equity be starting out in the marketplace. We know we had made an outlook, and we say we are always looking at this dashboard, and we can see the impact of the 100 basis point, the loan book. We are almost now at nearly 9%, where we almost within the range that had started from 10, and deposit growth, we are right in the middle of the range, and margins, again, closer to the range, but we have explained to you about, and return on equity again within range, return on assets within the outlook range, and we are off in NPLs, but we are working very, very hard. And we want to give ourselves this quarter to see what we can do. And the subsidiary contribution now within the range in terms of asset and profit and loss. Mary, who is now managing the subsidiaries, says confidently they will most likely close the year with a 20% contribution. As Polycarp says, I'll try to push back. So we are watching this competition between Mary and Polycarp in terms. And if you want to go to specific subsidiary, the data is all there on slide 44, so that you can tell how each of the subsidiaries, because this is a group result, but we have really broken down. I want to take this opportunity to thank you most sincerely for being so patient today to hear our story, to see our numbers, and to see our future. That's why we did quite a lot of trade analysis. I want to give you a chance. Maybe if there is one or two questions. I paraded before you the team that will answer the questions, but allow me to ask our investor relationship group director and director of strategy, Brent, if there is anything I've left on the presentation or anything you would love to tell the investors.
Thank you, James, and good morning to our investors and our analysts that are here this morning and maybe on the call. I think James gave a lot of the details to how the business has operated for the last 9 months. I think key to highlight is the consistency of how we've positioned the business as management. I think the key thing that may have slightly changed over the last 2.5 years, the positioning of the balance sheet, where a lot of the liquidity was increasing, particularly in James Mutuku's business, in terms of the treasuries that we've accumulated over time. That was largely for a defensive positioning, given the environment that we operated in. As you heard from James, the outlook that we're seeing across our subsidiaries, particularly in Kenya, and the positioning has changed in the sense that it is more of the nimbleness to take opportunities as they come. As James said, we were surprised with there was no changes, I suppose, in the ability to price for risk, but we feel that the environment is such that we should be able to price for risk over time. So the positioning of the balance sheet is to take opportunity of what will come over the next year or so, and it's no longer about being defensive. Also key to highlight is what we're doing from a strategic perspective. A lot of what you saw in the presentation is when money moves. As a bank, we historically focused on when money sits as a deposit and we lend it out, and you can see there's a lot of initiatives to release this liquidity that's sitting with James Mutuku in Treasury. But you can see when money moves in terms of payments, transfers, transactions, not only within the country, but also cross borders with what we're doing with trade finance and with Patricia's business for diaspora. There's this holistic approach to see how people interact on a day-to-day basis. It's not just about loans, but it's also how they make payments for their goods. So you can see there's a very strategic focus on how we look at the ecosystem that we operate in. It's very holistic. It plays on both parts of money, when money sits and when money moves. So I think I just wanted to highlight that as you go through the presentation as investors, as analysts, and even as the media, that the group is looking at things very holistically, and there's a lot of initiatives to ensure that we have the right ingredients internally. You've heard Batesh and the data scientists that we have on how we make more informed decisions using the data that we have. As James highlighted, we have 13 million customers across the group. You saw the number of transactions, the number of times they effectively interact with us. More importantly, the way they interact with us is on a digital basis. And every time you interact, that's a data point for us to make a decision on whether when money sits as a deposit and when we decide to lend, and make more informative decisions on who we lend to, but also on how we can just package this holistic approach that we have to the customer. So consistency in the message that we've been giving to investors over the last 2 to 3 years. There was obviously some tactical decisions we had to make, but also a lot of management time has not been spent on this, how do we position for the next year or for the next 6 months. But there's a lot of strategic thinking happening on how to position for the next 3-5 years. You've heard a lot of comment on how we're digitizing, what we're doing with FinServe, the data scientists, and also the management that we have. So don't just look at the short-term dynamics. Important is to see how we're positioning the business over the medium to long term as well. And there's a lot of data in the presentations we gave today and in the past presentations that we've given, that there is data points that investors and analysts can start building a picture of not only today or tomorrow, but over the next 3 to 5 years as well. Thanks, James.
And maybe Mary, overall, from strategy and subsidiaries, anything we have left, maybe you could add?
Thank you, James, and good morning. Thank you for coming. I think James has given the whole overview of how we see the business across the region. What is interesting is you may not have seen it here when the MDs were being introduced, but I can tell you what happens behind the scenes is amazing. You know, the competition, everyone is competing. Now they have a common person to beat, that's Polycarp. And they are also fighting among themselves to be the top. Celestine and Sam are neck to neck, I think, as at least at September. We are waiting to see how that will play out. But I think the opportunities are huge. In each of the countries has its own specific, unique opportunities, and that is what we are looking at, so that we can really capture the markets in the various locations, capture the customers, but more importantly, deliver the service that the customer understand their needs, and that's why the team led by Batesh is really important, the analytics, to let us know what the customer really wants to consume, and we are in a position to provide the solutions that they want. So we are really up to the task, and we are working on that. Some of the markets like DRC are very unique, as you heard from Celestine, huge population, good prices, the commodities have recovered, a hugely untapped population, banking, really unbanked population. So we are really out to roll out also very quickly the products that we've been able to successfully roll out in Kenya with the massive success. And we've seen already the advantages, and we've seen the early successes. Agency, we are also going to be able to do, we are doing the system integration. After that, we are able to do the unique easy banking products for that market also, which we have also done in Rwanda, we have done in Uganda with very huge successes. So we'll continue with those innovations in those markets. And I think the sense we are getting is that the customers love them. James talked about the convenience that it's giving the customers. and also more importantly, the fact that we are able to deliver them in a very, very affordable way. The costs are low because they are mostly on self-service platforms. So we'll continue with that, but obviously we'll keep you updated as we make strides in all those markets. But thank you so much for your support. Thanks.
Let me add to what Mary has said, and this is what will surprise most, is that Mary's designation was just Peak and Prague. It has worked in Kenya, just Prague in DRC, but just Prague in, and that's why the subsidiaries are growing that fast, because there's time to market, there's no innovation. It has worked, it has been tested, it has been proven. These economies are at the same level. When you look at politics, socio-economic dynamics, they are the same. So it's just Peak, Prague, and Play. And that is why you see the subsidiaries will grow very fast because they don't have to incur all the costs. The second thing is they are on the same platform. There's no question about, we'll do no, it's just a switch on a subsidiary. The platform capability is the same. So that's the advantage, and that explains to why combined the subsidiaries are taming Kenya. And from, but Polycarp, you not have a second chance to speak. So content with what I'm saying, because the data says you are losing ground. If you don't want to lose ground, change your numbers. Thank you very much. And now for questions, you know who to shoot your questions to. If you want to shoot to Shari Mutuku, maybe you could raise that. If you want to legal